Hey, beautiful people, it's Rickita and I'm back with another video. This is episode 103 of Credit 101. Please ignore my little bearded dragon that my kids have. I don't know how he moved into my office, but he is here and he is making noise for sure. So please ignore him. But in this episode, I want to talk to you guys about um, not just HELOCs, home equity line of credits, but also line of credit, but also any type of loans or credit cards. I want to talk to you guys about what happened when we have an economic downturn. Now, usually when we have these different things, um, they're going to stop, they're going to restrict, giving out money. They're going to scrutinize everything. So if you don't have the best credit score, it's going to be harder for you to get certain loans, certain credit cards, and that home equity line of credit, they're not going to be willing to really give it to a lot of people at this time. So that's why they always tell people be ready so that you don't have to get ready. Usually with a home equity line of credit, you can have that home equity line of credit sitting there. You don't necessarily have to just use it. And it is best to just have it for emergencies. So I always tell people, if you know that you have certain credit cards, you have certain things out there, won't you think about doing like a home equity line of credit and just have it sitting there just in case of like an emergency. And that's only for those people that's on credit. If you guys are already like debt free, you don't believe in this stuff, then you shouldn't really be watching me right now. But if you guys aren't using credit cards, you already using loans, maybe you want to look into that home equity line of credit and just have it sitting there, because you have to understand, even like during COVID, they're going to restrict putting out money. Okay. And a lot of times when emergency happen, if you don't already have that money, you can't just go and get it. And even like certain lines, say if you already have like certain credit cards, certain loans, not necessarily loans, but usually credit cards, what they'll do during times like this is they'll lower your credit limit. Okay, you guys have to understand, they'll lower the limit because they don't want to have that much money out there available to people, because they thinking, oh my gosh, something's going to happen. And sometimes you guys may even see this too, when you just have a downturn in your credit score in general. You're like, why did they lower my limit on my credit card? And it's because they looked at your credit score, they did a soft pulled your credit score and credit reports, and see that you possibly got a downturn right now, and they're restricting your access to that amount of credit. So please keep this in mind. So be ready, be prepared for these different things, and you guys will not have a problem at all. Usually it's those people that wait till something horrible happen, and then it happens to everybody, and they're like, oh my gosh, let me do something now. It's probably too late. Okay, so be ready, be prepared for it. And like I said, it's the same thing that happened during COVID, and anytime this happens again, like something major like that, it's going to be restrictions again. So please prepare for it and look into it. I'll see you guys in the next video. And hey, beautiful people, welcome to episode 104 of Credit 101. In this episode, I want to talk about reverse mortgages. Now, I want to kind of talk about the negative parts of it, because I've been doing a little research on it, and I know this is kind of, we want to talk about credit. It's not just about credit cards and things like that. We have to talk about mortgages and reverse mortgages, because I had a few seniors actually call me about this subject, and I was always told like it could possibly be like a bad thing, like you're not going to have your house anymore kind of situation. So I kind of did a little bit of research on it, and it's a few things that I actually want to point out. I have the notes here that I want to look at. So I kind of want to go over these things. If you guys want the good parts of it, this probably is not going to be too much of the video for it. I'm mainly going to point out the bad things, because to me it is a lot of downsides, and just a lot of things that you have to look out for when it comes down to this. So for one thing, if you guys want to do a reverse mortgage, you have to make sure that what I read, you have to be at least 62 years or older. So please look into that. Another thing is you have to live in this home. It has to be your permanent residence. So this has to be the home that you are living in. It cannot just be a home that you own. You have to actually live in this home. And if you are not in that home for 12 months, a consecutive 12 months, then they actually can call that loan due. So that's something that's very, very important. So if you were to go to another facility or whatever the case may be, you're no longer living there, then they're going to call it due. And remember, whatever you took from it needs to be paid back right away, or it could be a foreclosure process happening. Okay. So that was something that was like, what? It's so crazy. Another thing too is, say if it's a borrower of that home, you stand with that, but well, I don't want to say you stand away because I'm assuming that you guys are 62 or older if you're getting information. If the person that borrowed, they're one that's 62 or older, they're the one that borrowed the money for it. If they stay in that home and they actually pass away, then for you to get that property back, you got to pay 95% of the actual value of the house, or you have to pay what is owed, whichever one is less. Okay, if you don't do that, it's not your home, it's gone. Okay, so that was something that was like, okay, that's different, you know. And then another thing is, when they come down to reverse mortgages, they found that a lot of people are not getting these houses. A lot of people were just losing the houses when they die. It's just like basically you just get all your money up front. Sometimes you can do like a lump sum, or you can get payments out so they can pay you. And every time they take a payment, that's equity that they're taking out of the house, basically, that have to be paid back. And you have interest, you have different fees that's associated with that. And just because they're giving you a check, that does not mean that you have to stop paying the other things. You're in charge of like the taxes and things like that. You have to continue paying your bills, but they're going to basically just give you these payments. That's basically what it is. And you know, when a lot of people go out and get them an actual mortgage, they have fees. It's actually, they say it's more fees to do a reverse mortgage, because it's more fees to do the reverse mortgage than it is for people to actually buy the home. Now, do your research. This is just what I read. They said it's more fees. It come up to more. So definitely, I was just like, wow. And then one of the other things was, I already talked to you guys about you being left in a house, somebody being left in a house, and a person that passed away that actually did the reverse mortgage. I talked to you guys about that, and they said a lot of people make the mistake of putting the reverse mortgage in the oldest person's name, but we assume that they're going to pass away first. They should have put in the other spouse's name, or whoever it would have been. They should have put it in their name. As long as they were 62, they should put in the younger one name, because it's just, we'll think that it would be less likely for them to pass away sooner. Okay, we want to all get old. That's the goal. But we know life happens, and that's not what it really is. So that was something I was really like, what? Now, to me, this was the biggest one. Well, it's one more thing I want to tell you, that FHA have something where they can do this for a lot of seniors. Okay, they have it, and then they actually have some insurance out there. Same way you guys will have insurance if you don't pay like the 20%, or anyone will have insurance if they don't pay the at least 20% on their home as a down payment. You don't have the extra equity. You guys will have that insurance. It's the same thing with this. You guys are paying that insurance also. Okay, so if something was to happen, and for some reason, whoever loaned the money, whichever bank loaned the money, they don't get all their money, they can actually have that insurance to rely on. And people think that's an amazing thing, but all you're doing is paying on that extra insurance. I know a lot of times seniors cannot get the different loans that they need, but to me, listening to this is not an option. And seeing that a lot of my family, I always see a lot of people that if they're elderly, they do have a house that's paid off. They're already on government assistance like food stamps. They're getting the insurance through there. You have to understand that this is going to be considered income. Yes, it's going to be considered income. So whatever money that you guys are getting in these payments, you have to include that in your income, and it can actually make you not eligible anymore for the food share. Now, definitely, I'm just putting stuff out there. Just look into these different things. This was a touchy subject, just like taking money out of your, I think it was like 2 episodes ago, we were talking about taking money out of your tax deferred accounts. This is something I had to do some research on. Definitely do some research on this and understand when it comes down to taking money out of these different things, or possibly doing these reverse mortgages. The bank is probably, to me, not the best person to talk to. You could talk to them and ask them what fees you're going to give and what's possibly possible. But you want to talk to like a financial advisor, or talk to someone that is very knowledgeable on this. And I would try to figure out what's the bad things instead of just the good thing. The good thing is you're going to be able to get the money. Okay, the bad thing is you can't leave this house to your family. This money is going to be due right away if you don't stay on it for 12 months. Even if you were to go to a facility, they can call it due, and you're gonna have that money right away. And then except for the first year or two, you don't even really get all your money up front. I mean, I don't want to say you can get all of it up front, but they try to restrict how much you can get within your first month. I mean, not first month, your first year. So definitely do some research. I just want to bring this information to our community so that we can think about things like this, because it's like stranger danger, warning, warning. And to me, this is one of them. So hopefully you guys get some information out of this and be like, wait, what? And then you can do more research on it. But I'll see you guys in the next video. Bye-bye.